The Intelligent Investor, published in 1949 by Benjamin Graham, is a seminal work on value investing that emphasizes a rational and disciplined approach to the stock market. Let's explore the three core principles that form the foundation of Graham's investment philosophy. We'll cover three key principles: value investing, the concept of Mr. Market, and the critical margin of safety. Value investing is about identifying and investing in undervalued stocks with long-term growth potential, regardless of short-term market trends. The core focus is on a company's intrinsic value rather than its market price. Graham emphasized that successful investing requires patience and a long-term perspective. Mr. Market is Graham's allegory for the irrationality of the stock market. He describes the market as an irrational business partner who offers to buy or sell shares at different prices every day. Sometimes Mr. Market is too optimistic, offering high prices. Other times he's too pessimistic, offering low prices. The intelligent investor can take advantage of these mood swings, buying when prices are low and selling when they're high. The margin of safety is perhaps the most critical concept in Graham's philosophy. It represents the difference between a company's intrinsic value and its market price. This buffer provides a cushion against errors in valuation and protection against adverse market conditions. Graham considered it the secret of sound investment. The larger the margin of safety, the lower the risk. Graham's investment strategies were not just theoretical. They achieved average returns of approximately 20% per year over nearly 30 years. The beauty of Graham's principles is that they can be applied by everyday investors. They provide a framework for making rational decisions in an often emotional market, helping investors protect their capital while achieving adequate returns. Benjamin Graham's principles from The Intelligent Investor have stood the test of time for over 70 years. Despite being written in 1949, the core concepts of value investing remain fundamentally sound in today's financial landscape. Value investing focuses on buying undervalued stocks based on thorough analysis of their intrinsic value, creating a margin of safety between price and value. However, modern investors face unique challenges when applying these principles to today's complex markets. One major shift is the dramatic rise of intangible assets. In 1975, tangible assets like factories and equipment made up 83% of S&P 500 market value. By 2020, this flipped completely, with intangible assets like intellectual property and brand value comprising 90% of market value. Benjamin Graham's influence extends far beyond his own time. He created a lineage of successful investors who have adapted and expanded his principles. Warren Buffett, Graham's most famous student, refined these valuation techniques for the modern era. Others have expanded into areas like behavioral finance and quantitative analysis, all building on Graham's foundation. One modern extension of Graham's work is understanding how psychological factors impact investing decisions. Behavioral finance identifies common biases, like confirmation bias, where we seek information that supports our existing beliefs, and loss aversion, where we feel losses more strongly than equivalent gains. Interestingly, Graham's allegory of Mr. Market, the manic-depressive business partner who offers wildly fluctuating prices, anticipated many of these psychological insights decades before behavioral finance became a field of study. Today's investors have access to tools and financial products that weren't available in Graham's time. Index funds and exchange-traded funds, or ETFs, align perfectly with Graham's advice for defensive investors. These low-cost, diversified instruments allow individual investors to implement his strategies with minimal effort. One of the most significant developments in modern investing is the evolution of the relationship between growth and value investing. Traditionally, these were seen as opposing strategies. However, many modern investors recognize that a growth stock can also be a value stock when purchased at the right price. Warren Buffett himself evolved from Graham's strict value approach, famously saying that growth and value investing are joined at the hip. The key is determining the intrinsic value of future growth. To effectively apply Graham's principles in today's market, investors should follow these key adaptation strategies. First, always focus on intrinsic value rather than market movements. Second, maintain a margin of safety in all investments. Third, control emotional responses to market volatility. Fourth, use modern tools while preserving core principles. And fifth, adapt analysis methods to different types of businesses. As Warren Buffett, Graham's most successful student, famously said, "Price is what you pay, value is what you get." This sentiment perfectly captures how Graham's timeless wisdom continues to guide investors through the complexities of modern markets.